How to use high delta options for directional trading. Are you curious about how to maximize your trading strategy using high delta options? Let's break down how these options can help you make informed directional trades. High delta options are contracts that have delta values close to 1-4 call options or close to -1-4 put options. Delta measures how much the price of an option is expected to change for every $1 move in the underlying stock. Essentially, high delta options move almost dollar for dollar with the stock price, making them very responsive to price changes. To effectively use high delta options, start by grasping that delta indicates price sensitivity and directional exposure. For call options, delta ranges from 0 to 1. High delta calls, typically between 0.8 and 1.0, behave similarly to owning the stock itself. On the other hand, put options have delta values ranging from 0 to -1, with high absolute values indicating a strong sensitivity to downward price movements. When you trade high delta options, you are essentially gaining stock-like exposure without needing to buy the actual shares. For instance, if you have a call option with a delta of 0.9, it will increase in value by about 90 cents for every $1 increase in the stock price. This allows you to participate in the upside with less capital than buying the stock outright. Another advantage of high delta options is that they often have a higher probability of expiring into money. This means they are usually into money or deep into money, which increases the likelihood that the option will finish profitably. This is particularly appealing for traders who are confident in a strong directional move. Now, let's discuss some practical steps for using high delta options in your trading strategy. First, select high delta calls for bullish trades or high delta puts for bearish trades. This ensures your option position closely tracks the underlying stock's price movement. Next, consider using high delta options to gain stock-like exposure with less capital. This can improve your capital efficiency compared to purchasing shares directly. However, managing risk is essential. Even though high delta options behave like stocks, they still have a limited lifespan and can lose value quickly if the stock moves against your position. It is also important to consider the option's time to expiration. Longer-dated high delta options can reduce the impact of time decay, giving your directional thesis more time to play out. Keep an eye on delta changes as the stock moves. Delta is dynamic and will increase as the option goes deeper into money, aligning your position with the stock's price movements. Lastly, you can use delta to estimate hedge ratios. If you want to hedge part of your directional exposure, delta can guide how many shares or contracts to buy or sell to maintain a neutral or adjusted directional stance. In summary, high delta options provide a way to trade directional views on stocks with contracts that closely mirror stock price movements. They are particularly useful for traders who are confident in a strong move in the underlying asset and want to participate with options that behave similarly to owning the stock. Understanding delta and its implications on option price sensitivity and the probability of expiring into money is essential for effectively using high delta options in your trading strategy.